If you're an entrepreneur, you've taken big risks, created many jobs, and devoted yourself to your business. When it comes to building your succession and transition plan, who should be involved? What are the steps along the way? Welcome to Finish Big, the podcast with Mark Dorman, sponsored by Succession Plus, inspired by the book Finish Big, How Great Entrepreneurs Exit Their Companies on Top, by the noted entrepreneurial author Bo Burlingham. In this podcast, we share success stories along with our expertise and knowledge about what will probably be the largest financial transaction of your life. Now, on to the show.
Hello, this is Mark Dorman, your host of the Finish Big podcast, and welcome to another episode of Finish Big, where today we have a very, very special guest. A gentleman who's become a good friend over the last 15 years. His name is Scott Gabehart. Let me tell you a little bit about Scott. Scott has been the Chief Valuation Officer for BizEquity, the world's largest business valuation platform, since 2006. You'll recall, ladies and gentlemen, that we had Michael Carter, the CEO, on our show a few months back, and it was extremely well received. We want to touch on that again. But in addition to being the Chief Valuation Officer for BizEquity, Scott has 30 years experience in private firm valuation and transactional representation. He's a certified business appraiser, a certified valuation analyst, business certified appraiser, which are three of the five recognized designation by the Small Business Administration and the Internal Revenue Service. He's co-authored business valuation requirements for the Small Business Administration change of ownership loans. In addition to all that, he's also a faculty member at the Thunderbird Global Institute for Global Management, and he's, for the last 7 years, he's been teaching private firm valuation courses and teaching graduate level courses at the University of Phoenix. He is a co-founder of the Business Valuation Institute, which offers the Certified Business Valuation Specialist, or CBVS designation. He carries a master's in business administration plus 2.5 years of economic study in the PhD program at the Arizona State University. He's also taught economics full-time for 4 years at local community college. Scott Gabehart is also the author of numerous books and articles related to private firm valuation. Scott Gabehart, my friend, welcome to Finish Big, the podcast.
Thank you. It's great to be here. Looking forward to our chat.
Yeah, well, we are going to dig right in here. So there's a lot to unpack just in your bio, but we first met probably, as I said, about 15 years ago at the formation of BizEquity. Let's talk about, first of all, where is BizEquity today? I'm very good friends with Michael Carter. I know they did a transaction with the American Business Journal Association. Maybe you could touch on that, but it's still, by all accounts, is the world's largest business valuation platform, correct?
Yes. And of course, we occupy a special niche being entirely online. Our client base includes wealth advisors, insurance agents, CPAs, attorneys, business brokers, consultants, exit planners. Over the history of the firm, we've managed to continue growing every year, including several large banks, which we're proud to be serving as well as wealth management companies such as Morgan Stanley. It's a long and growing list.
Yes. I mean, one of the things that I've learned in the past 12 to 15 years in my dedication to the small business marketplace, which is a passion you and I share, and Michael certainly shares as well, this incredible statistic that 98% of small business owners do not know the value of their business. Does that still ring true today?
Well, I would say that more or less that's true. And
I mean, that's just an amazing number, right?
Yes. In many cases, they're just misinformed. They may think they know, but once you dig into the details, many times they're surprised.
But just the number of business owners that clearly are operating in the fog, and in my travels, and those are some of my colleagues in this space, one of the most important questions that we ask our business owners is, do you know the value of your business? Or tell me what your financial advisor, what does he or she tell you about the value of your business? And inevitably, the answer that I get, Scott, is, well, we don't talk about that. Mark. I mean, we talk about, $500,000 IRA rollover or a few bucks I've inherited from my parents, et cetera. And I kind of just sit back in my chair. I said, we hear that answer a lot, Scott. It's interesting that 90% of a business owner, his or her wealth is tied up in the value of their business, but any type of financial advice or planning advice they seek is really limited to the absolute tip of the iceberg. Agreed?
Definitely. I've always said that understanding a client's business value is probably the single best way to enhance your status as an advisor, whatever type of advisor you might be. Taking the time to learn the fundamentals of business valuation and to be able to explain to a business owner what their company's worth and what some of the key value drivers are, and to help shape their business future, I think is obviously a very valuable skill. We do our best to help train the advisors who work with us to walk the walk and talk the talk and truly help their clients.
I agree with that completely. And I echo those sentiments. I mean, to play back that response that we get, hey, we don't really talk about the value of my business because we're too busy talking about my IRA or my 401k plan. And I said, we're the advisors for the conversation about the value of 90% of your wealth. And we feel that makes more sense, Mr. Business Owner. And inevitably they pause and go, yeah, now that you mention it, Mark, that really, really makes more sense to me. Let's talk about why business owners need to know the value of their business. I mean, there's obviously, you should know, but there's a number of different planning items out there, whether it's buy, sell, could be purchase, buyout, et cetera. Maybe walk us through a few examples of specifically why business valuation should be top of mind for business owners today.
Yeah. Well, I think the first and really primary reason is one of value optimization. As you've suggested, business typically or quite frequently the single largest asset in a business owner's portfolio. Being proactive in understanding the valuation process and building towards wealth enhancement is in and of itself a very worthy goal. Aside from that, we have a number of, you might say, transactional causes or needs for business valuation.
Things that you say, well, I need to get one for a divorce, or I need to get one for the death of a shareholder, right?
Yeah, exactly. Event-driven requirements, issuing shares for key employees, getting a bank loan using the SBA program, for example. Over the course of the life cycle of a business, there are these event-driven needs which arise, and each of those valuation scenarios are different, and it's certainly important to be tracking your business value along the way, and that will help when the time comes for formal business appraisal.
Play that back to a little bit. I mean, what I heard you say there is, hey, ladies and gentlemen, one of the reasons why you need to know the value of your business is because if you don't know where you're starting, you don't know how to make it more valuable, correct?
100%.
Yeah, and what the value drivers are there. So that leads us preaching right into the exit plan mantra, particularly the Exit Planning Institute, about value acceleration methodology. But it starts with, what is my baseline value today? But then there are also all these other events, whether it's the death of a shareholder, estate planning, gifting, the buy-in or buy-out of a shareholder, treatment of key employees, et cetera.
Yes.
But for years, business valuations were $10,000, $12,000, $15,000 and took months and months and were very, very intrusive. That certainly isn't the case today with BizEquity.
That's very true, and have great confidence in the accuracy of our tool. I like to explain it as the BizEquity value estimate, 95% of the time, will fall in between the range that you would obtain if you hired 5 professional appraisers, provided the same fact pattern. That reflects the nature of business valuation. It is both an art and a science, and every valuation is ultimately an opinion, but it's an opinion based on facts and generally accepted valuation principles and procedures. And the BizEquity model mimics the work of a business appraiser conducting a formal valuation. I would be misleading our listeners to say that BizEquity in and of itself is the answer to all valuation requirements, because there are certain instances, such as a formal estate and gift tax plan implementation, which requires a quote unquote qualified appraisal from a quote unquote qualified appraiser. Understanding the principles of valuation and being engaged within the concepts that drive business value obviously is a plus, whatever your need might be for an event-driven valuation.
I completely agree there. When we talk to our clients, BizEquity gives us a good baseline discussion draft, so to speak, right? But where you and I have gotten to work more closely is if the need calls for it and we need a certified business appraisal, oftentimes, but not always, for sure. I mean, the vast majority of the time, the BizEquity valuations are being done kind of at a high level. It's the effort to, what's the term you guys use, democratize business valuation, right?
To avoid having to pay that $12 to $15 and now $20 to $25,000 for a full appraisal when it isn't always necessary.
When it isn't always necessary, right? If you need to find out what should we fund our buy-sell agreement at, it's close enough. What is perfect is the enemy of good, right? We don't need to spend 25 grand when we can get 95% of the way there. For
exactly. So many stories that I've heard over the years of how our value estimates have been right in line with reports that cost $25,000 and more. We even, for example, made an attempt to value X, formerly known as Twitter, and based on publicly available information after Elon Musk had said that because of the advertiser dropout, the value had dropped to $4 billion and everybody was up in arms. How could it be $4 billion? And we right away said, well, no, it's probably not $4 billion. And we think it's 16, 17 billion. And then 2 weeks later, he announced the valuation results that was done for executive compensation, and it was 20 billion. It's a pretty versatile tool if the data is entered properly. And that's just an example of how through practice and time, we've learned that the tool is accurate and helpful and worthwhile.
Yeah, definitely. Were you there at the very genesis of BizEquity?
Yes.
How did you and Michael meet, and how did that conversation go? Like, hey, I've got this crazy idea to make the Zillow of business valuations. What do you want in?
Yes, that's sort of what happened. But as you know, Mike is a very unique and driven and skilled entrepreneur. He made his pitch to me and I jumped right on board. And of course, for a few years there, I was more or less working without pay. It doesn't take long to know that Mike Carter is serious and he knows what he's doing, and he's a good person to hitch a ride with.
Mm-hmm. And so today, what's your current role at BizEquity? Are you still working with the various programmers, et cetera, to continuously stress test, keep the quality control steady, et cetera?
Yeah. Yes. For several years, I was doing substantial traditional formal appraisal work when it was required by our clients. Mm-hmm. But a couple of years ago, we decided that my time was better spent improving the algorithm and the product. So in addition to monitoring and updating the multiples, I'm doing a lot of research, and I've presented at NACFA a couple of times recently, doing interviews like this. But most interestingly, I think we're improving the report, the algorithm and the report. For example, we just rolled out a capability to value minority interests. As you know, estate and gift tax valuations almost always revolve around a minority interest, a non-controlling interest, a 5% interest in stock, and discounts are applicable. And as a result, you could just take a pro rata guess of the control value, but that's not how the real world works. So we now offer the ability to apply discounts for lack of control and for lack of marketability that bring these final numbers in line with what would be submitted in a formal appraisal.
Mm-hmm.
for example. That's one of
Yeah,
the.
no, that's great stuff. One more question I want to explore in BizEquity, and I want to move into kind of the capital markets today and your role is in a teaching, and your obviously love of the profession, wanting to give back to the younger professionals. But one of the things that most impressed me about the BizEquity report, it's very, very robust, is you have these key performance indicators or KPIs, kind of the second part of the report. And we've found those to be really incredibly valuable in discussions because business owners, as you know, they live a bit in a vacuum. And not only do they not know what their business is worth, but they don't even know how, they'd love to know how they stack up to their peers, right? Not necessarily the guys or the ladies down the street in the industrial park, but are they in line with industry benchmarks? So could you comment on the value of those KPIs, and when were they always included in the original platform?
The KPIs have been there from the beginning, and they are a natural corollary to the value estimates. As a general proposition, the better the KPIs are, the more valuable the company will be. Of course, we produce, I think, around 15 of these KPIs, and not all KPIs are relevant to all companies at all times. So there's a bit of a finesse to using the KPIs as well. There's a handful that will almost always be important, such as the cash flow margin, which is the best gauge of profitability, the interest coverage ratio, which is a good measure of
ability to service debt.
Yes, solvency was the word I was looking for. Basically, there's 4 or 5 of these key ratios that address liquidity, solvency, activity, and profitability. And in my opinion, those are the ones that you'll typically want to hone in on, just depending on the type of business. Retail companies, of course, are dependent in large part on inventory and those metrics, inventory turnover, for example.
Not only can a client get a valuation, and folks, for those of you who are listening out there that own your own business, you're not only just getting one valuation methodology, but you're getting 4 valuation methodologies, but you're also getting, 12 to 15 key performance indicators that are industry specific.
I think that the importance of the KPIs, besides helping to understand what's valuable about the company, is that they, as you mentioned, they provide a means of communication between the advisor and the client, and a way to, in effect, demonstrate your prowess and your value to the client by walking through those KPIs and discussing potential areas of improvement.
Hi, this is Mark Dorman. Sorry for the interruption. I know you're listening to the Finish Big podcast, and I'm excited to have you here. If in the event you have any questions, please head over to www.succession.plus/US, where you can find out how to reach me. I'd love to hear from you. And now back to the show. Excellent. So let's move on from BizEquity, and let's talk about valuation marketplace today, if you will. Or more specifically, the capital markets today and where business valuations are in terms of multiples, the impact of interest rates, perhaps, Scott, and the fact that you hear that there's so much, dry powder out there and so much money chasing too few deals. So let's start with multiples. Have you seen multiples come down as a result of the 14 to 15 rate interest rate hikes we've been exposed to over the last 20 to 24 months?
Absolutely. To summarize, you could say that overall M&A marketplace has moved from a correction to what might be considered a downturn in the big picture. But clearly, there are exceptions. There are industry exceptions. One of the most glaring differentials that you'll see with respect to multiples is in for example, the professional services industry and the role that private equity is playing. You will see a differential of, let's say, for a financial buyer paying 5 times EBITDA. And at the other side of the spectrum, private equity firms will be paying 10, even 12, sometimes 15 times EBITDA. And there's a method to their madness. Obviously, they're working with management and building a management team and a roadmap for increased revenues and profits in the future that justify that higher multiple today. But
so more like a platform professional service purchase that they're going to, bolt on other acquisitions down the road. So this first one or second one is much more valuable to the PE firm. Is that a different way of saying it?
Yes, that's correct. I took a look at one of our clients' list of valuations and multiples for professional services companies, and they indicated for each deal, each multiple, whether it was a financial buyer or a private equity or corporate buyer, and the difference was just mind-boggling. If you have a significant professional services company today, you definitely want to pursue private equity exit options.
And that's just, so I mean, but in your world, when you say professional services, here in Northeast Ohio, I think accountant, lawyer, architectural firm, but I've come to know that it could be industry trade association providers. It could be, I know private equity is now in the medical space, right? I mean, I've got a friend of mine. Heart and vascular. I mean, it's kind of like no holds barred as to where private equity won't go, right?
That's right. And they still have that dry powder, but at the same time, the federal government is just starting to push back. And they've even changed their definition of what is considered monopolistic presence in a given market. They've changed the percentage. They're essentially changing the rules that affect the ability to execute transactions in some of these industries that they ignored in the past. Yeah. And they're kind of honing in on private equity because there's been a downside to private equity being 40 to 50% of the total M&A market. Things in the medical industry, as you alluded to, such as a deterioration in the quality of service.
Agreed.
Still very profitable, but at what cost?
Correct. No, I mean you could see that coming, right? I mean, as we reach for profits, maybe the quality of care goes down. As it's just human nature. But
yeah,
interesting. With the interest rate increase, are you seeing any slowing in deal flow based upon the marketplace today, or do you see? I mean, and then the Fed just came out and said, "Hey, we're going to pause on rates, but we might actually cut them." So that's probably music to the capitalists' ears, right?
Yes, the deal flow has definitely slowed, but it has slowed more for the larger companies than the middle market and the lower middle market. Those to date have been somewhat of the sweet spot in terms of not seeing a decline in deal count and the multiples not going down as much as surrounding smaller and larger companies. And of course, higher interest rates have changed the deal structures, meaning more cash down and more equity financing and less borrowing.
Correct.
And at the same time, the higher interest rates coupled with economic uncertainty have changed the balance between buyer and seller power in negotiating the deals. We've shifted from a seller's market to more of a buyer's market.
Yes, I can see that. One last question. When we talk about the lower end of the middle market, let's talk about what we refer to as the micro market, which would be companies with annual revenue, let's say, of 30 million or less. I mean, heck, you can have a $10 million revenue company manufacturing here in whether it's Philly, Boston, or Cleveland, 15% EBITDA, great little business.
Yes.
Almost ignored by the PE firms, right? Can't really get good investment banking representation. What's going on in that kind of micro market, if you will?
I think that possibly the biggest change would be the impact of a slowing economy, less growth in GDP, which means that on average revenues are suffering somewhat and then profits are suffering. And as happens in every recession, these firms become relatively smaller, and the phenomenon we refer to as the size effect kicks in reverse. As the amount of available earnings declines, the multiples actually decline.
I think that, you and I both know, but this is many of our listeners. I mean, the smaller companies, the micro companies, they also suffer from a lack of buyers, right? I mean, there just isn't as much. There's the capital. What they hear about the private equity firms, they aren't chasing, the $10 million phenomenally profit, well-managed manufacturing company. They're kind of flying over those on the way to the $100 million company. But yet, I suspect that it really is very fertile ground for maybe some of these family office groups that have established themselves, where they're going to have bolt-on acquisitions and start to add 10 million of revenue here, 15 million there, 5 million there. And all of a sudden, you're buying it at a significant discount and selling it at a premium, the roll-up strategy. Yeah. So as we look to kind of conclude our show, and this has been great. Our guest today has been Scott Gabehart, who is the Chief Valuation Officer at BizEquity. BizEquity is a great friend of the show, but you must obviously love teaching, Scott. When I was reading your bio, adjunct professor here, you taught here. When do you find time for that? You must really enjoy it.
Well, I do, but to be honest, I haven't actually taught now for several years, and that's a function of being dedicated and devoted to BizEquity. But yeah, teaching is great, and especially, in my opinion, at the time I was teaching 6-7 years ago, the virtual teaching was kind of like this important in the grand.
Yeah. Now it's a change. COVID changed the game, right?
Yeah. And all right, that's the way it is. And that's what the students demand. But there is absolutely no substitute for being in the classroom with students, interacting with the professor. And I think a negative development in education overall.
Yes. I mean, I think academia has taken far too much advantage of the ability to get out from being live in front of the student. I know my youngest son was a victim of that at WVU. Scott, this has been great. You've become a great friend of the show. Professionally for me, I've been able to, over the years, call you and ask you questions. Where can people get a hold of BizEquity?
Well, the best route would be bizequity.com, BIZEQUITY.com. You can find me on LinkedIn or Google my name. I'm always open to conversations on various fronts related to valuation.
Yep.
Can I finish on a positive note?
Yeah, for sure.
Yeah, the M&A market's down. We may still have a recession. Interest rates may come down. I'm sure they will come down eventually. It's a question of when. But what I would like to point out is that for the micro market that you referenced earlier, at least the smaller end of that micro market, the ability to get SBA financing to buy a business is absolutely as borrower friendly as it's ever been. Meaning this last iteration of the SOP 50-10, which is the rule book for 7A loans, which include change of ownership loans, they eliminated the personal liquidity rules. You can theoretically buy a business with no cash down now. The bank may not go for that, but it's possible.
Yeah, the bank might not go for it, but your wife or spouse might, right?
They would love that. Yes. Bottom line, we don't have time to go into all the details, but they made a series of changes that have really made it easier, take advantage of the benefits of SBA financing, which are good for both the buyer and the seller.
Yeah, I think there's so much there that you've said that needs to be said. It's so vitally important to the economy of this great country to keep healthy small business operating. They create 80% of the jobs, as you know. And it's not the 1,000-person employee. It's the 50 here, 25 there, and they all add up.
Yes.
And we know that succession and exit planning preparedness is mission critical. And the SBA, with the credit of guys like you, have really helped them get their hands around it and become better lenders, I guess is what you're saying, right?
Oh, definitely.
Well, maybe we'll have you on the show. I've got a good friend of mine, Tara Murphy, here in Cleveland. Huntington Bank is one of the top SBA lenders in the country. They're number one, but maybe she does a lot of SBA lending in the buyers space, buyers and sellers, and maybe we could do a little forum on that. I'd like to explore that. We got to go for today, Scott. This has been fantastic. Talk to you all day and learn a ton. Our guest today, ladies and gentlemen, has been Scott Gabehart, the Chief Valuation Officer of BizEquity. Check him out at www.bizequity.com. This is Mark Dorman, your host of the Finish Big podcast, how great entrepreneurs exit their companies on top. Until we meet again, here's to finishing big. Thank you.
Hope you enjoyed listening to Finish Big, the podcast with Mark Dorman, sponsored by Succession Plus. Don't forget to click the follow button to be notified when new episodes become available. Visit our website at www.succession.plus/US or give us a call at 330-350-5410. The information covered and posted represents the views and opinions of the guests and does not necessarily represent the views or opinions of Succession Plus. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional tax or legal advice. Always seek the advice of your legal or tax professionals with any questions you may have regarding your specific situation.